How the heck do you pay taxes on Roth conversions? Hi, this is financial planner Sean Mullaney. Let's discuss. So this is the flavor of the day. Folks love taxable Roth conversions, particularly in early retirement, but even in later retirement, right? Let's affirmatively take one of our traditional retirement accounts, often a traditional IRA, move money directly from that traditional IRA to a Roth IRA. That's called a Roth conversion. And we're doing it maybe in early retirement where we want it fully taxed. What we're doing is we're doing tax rate arbitrage. We're saying, look, we're early retired. Our taxes are artificially low. So guess what? We just want to pay taxes now on some amount in those traditional retirement accounts. So we'll affirmatively elect to pay taxes and now get them in a Roth IRA. And now they're growing tax and penalty free. That's awesome. All right, but the question comes up, well, how the heck do I pay my taxes on a Roth conversion? And it depends on your age. All right, let's start if you are under the age of 59 and a half. If you are under the age of 59 and a half, to my mind, there are two main ways to pay the tax on a Roth conversion. The first way is through W-2 withholding. So maybe you have a side hustle or a part-time job. Maybe your spouse has a W-2 job. One of the ways you could pay the tax due on a Roth conversion is just up the withholdings to Uncle Sam and maybe the state and get the tax paid in that way. That's a really good way if you're in that situation where you have a W-2 job. You may not be in that situation though. So then where do we go? Well, okay, we should probably just pay the tax out of our cash accounts or taxable brokerage accounts. Right? What that does is it whittles down a non-creditor protected asset, an asset that generates taxable income through interest and dividends and capital gains later. And it gets the tax paid though, and you do it through estimated tax payments. I'll link to something called directpay.irs.gov. That's a mechanism to make quarterly estimated tax payments. So that's the second way. And for a lot of Americans under the age of 59 and a half, that's probably going to be the way you pay the tax due on a taxable Roth conversion. Now, notice one thing I didn't say. I didn't say take the money out of a traditional IRA to pay the tax to Uncle Sam or the state taxing authority. Here's the thing. If you're under age 59 and a half, that's probably going to attract a 10% early withdrawal penalty. So if you're under 59 and a half and you're doing Roth conversions, more power to you, right? For a lot of people, that's a really good planning strategy. You got to do your own analysis. I can't tell you in this video if it's good for you. But I will say if I were under 59 and a half and I was doing taxable Roth conversions, I would pay the tax either through W-2 withholding myself or my spouse, or just through my bank account that's just in my cash, my taxable cash, or just sell some taxable brokerage accounts and assets and pay the tax to Uncle Sam through quarterly estimated tax payments that way. All right. Well, what if we're age 59 and a half or older? Well, now we have three things on the table, right? W-2 withholding, if we have a side hustle or a spouse has a job. We have the taxable accounts, the cash, the cash accounts, the brokerage accounts. We do directpay.irs.gov for that, quarterly estimated tax payments. Or we have a third mechanism that's actually a really good mechanism. That third mechanism is withholding from an IRA withdrawal. Now, technically, it could be a 401k withdrawal too. It's probably just going to be easier for a lot of Americans to use their traditional IRAs. You can go into your traditional IRA, usually preferably later in the year when we have a better idea of the sum total of our tax situation, and you can generate a distribution to yourself. And then you can elect to have the financial institution withhold more than the default, which is 10% to the IRS. You say, no, financial institution, pay a whole bunch of that distribution just to the IRS as a withholding tax. That can pay the tax on your Roth conversion, and it's deemed to occur equally throughout the year. So it's a really good way to do it. Now, you got to remember, you've created more taxable income by doing that. But, you can do that later in the year, and that can be a very effective way to pay the tax on taxable Roth conversions. Now, there's one flavor of Roth conversion you should never pay tax on, or you should pay de minimis tax on, and that's the Backdoor Roth IRA. It's also the Mega Backdoor Roth, by the way. People say, well, how do I pay the tax on the Backdoor Roth? The answer is you don't. The whole point of doing a backdoor Roth is we're not paying additional tax. Now, yes, maybe the amount in the traditional IRA when we did step one of the backdoor Roth grew by 10, 20, 30 bucks. Okay, fine. That's a little bit of taxable income, going to generate just the tiniest little bit of federal income tax. But we're doing a backdoor Roth because we have high other income anyway. So we should be making estimated tax payments or W-2 withholding at work anyway. So when we're doing a backdoor Roth, we should not be doing any income tax withholding on our backdoor Roth. Hope you enjoyed this video. If you did, please mash that like button and subscribe to my channel. I'll see you next time.